Hey everybody, Marty Mazur. Good evening. It's the 8th of November 2016, election night in the U.S. It's late. It's 8:30 Pacific time. I'm coming to you because I want something in your email box to help you put what I'm looking at into perspective. Looks like this is a delayed quote, but I'm looking at a Dow future that's down about 700 points. And I'll bet all of you know why. It's because it looks very likely, at least at this juncture, that Donald Trump is going to win the presidency. It will be unprecedented, I believe, in terms of what the polls were saying leading up to it. I can tell you the betting odds had it over 80% that Hillary Clinton was going to win tonight. Like Brexit, the betting odds, which are typically very reliable, looks like they had it wrong, although it's not over yet. Apparently, Mrs. Clinton has a narrow path, but it doesn't look good at the moment. And clearly, the global markets, currency markets, we're seeing it pretty much across the board, are shocked at what we're seeing. Now, there was evidence, and I could see it in some of the indicators in terms of what options traders were doing, kind of off and on today, but there did seem to be some hedges taken today and then taken later in the day and so forth. And to some degree, from what I hear, at least anecdotally, some really big hedges were taken from some big-time traders. Those hedges that bet on the short side of the market or the market falling, ultimately they get covered, and typically it can be quite violent upside reactions when hedges get covered. But I can tell you sentiment was really weak. In fact, I'll start playing with the chart here in front of you. The sentiment indicators today, this is, I'm circling here, that was the Brexit recent low. And you maybe recall, this feels like deja vu all over again. You had polls and odds makers giving you pretty strong confidence that we were going to have one result went the other way. We had a 600-point decline on the Dow the next day, 300-point decline on Monday. This was Friday. This is Monday. And then that's all we got. And I explained this ad nauseum several times. Going into it, sentiment was very weak, and cash levels and particularly mutual funds was high. It's hard to have just an all-out washout when sentiment was already weak. If sentiment had been very, very strong, if it were on the opposite, say 70% bullishness and very little cash in portfolios, then I would have told you that would have felt like a cataclysmic event. We would have come out of it, and we might be right where we are, but it would have gotten a lot worse before it got better. I'm not promising that Trump winning would be just a two-day sell-off, or to what extent it goes down. But I wanted to interact with the chart here on your behalf and basically illustrate for you that whether it was this election that looks like we may get a surprise result or entirely something else, the level that we're looking at least initially, of a drop, at least if I just use tonight's level, and I'll illustrate that for you here in a second, is completely and 100% within the norm of normal retracements of rallies. Now, I want to give you a couple of examples. Now, these are called Fibonacci retracements. These are something that technicians use quite religiously to give them a feel, and these would be short-term traders, when and where to place, to put positions on or take positions off and hedge and so forth. So I'm going to go down to the very now famous February low, and I'm going to take it to the April peak. So we had a really nice bounce back rally after the worst start to a year in history. And the market peaked right there in April, as I said. It retraced down to this 23.6% level. You can see that held. But that's not a normal retracement. A normal retracement starts at 38.2. More often than not, you get at least a 50% retracement before you bounce back. 62 seems to be the not necessarily a line in the sand, but that tends to be very strong support in a retracement type sell-off. All the way down to 100 is typically, this is where you would see traders probably go crazy and begin buying the market again, unless we just had a complete and utter breakdown of all the technical indicators. And there'd be a lot of breakdown, be a lot of damage done there. But you can see this was in the context of a very normal retracement, nothing out of the norm whatsoever. Now, if I take that peak there and move it to the recent peak, the recent all-time high, where we peaked there, kind of came off of it, you can see that we did retrace, and ironically, again, we came down to that 23.6, and we found support there. That's typically not a strong line of support for a retracement. Typically, it gets stronger at about 38.2 and then 50% and so forth. So let me fold on the current action in the Dow future contract, it's going to be down a lot. So several 100-point decline. If we were to open today, we would have that Dow drop down this far. And as you can see, even with that decline, and again, for whatever the reason, we still aren't at even your first level of what is generally strong support from a retracement standpoint. Lots of traders trade these Fibonacci retracements as really their primary trading vehicle or trading indicator. So some of them are probably waiting for this retracement to happen. And by the way, I'm using the Dow this evening. As you know, I normally use the S&P because I think it's a better, broader index. But because I know, I'm reading the headlines, listening to the news, everybody talks about Dow futures. It's more dramatic to say, a 600-point or a 700-point decline in the Dow as opposed to an 80-point decline in the S&P. Percentage-wise, we're all talking the same stuff. But so in the context of what we're seeing tonight, we're still not to what would be a normal retracement. More likely, given the news and if it's as dramatic as maybe people will see it to be, maybe we get a 50% retracement, which would take us down to about 17,000 on the Dow, maybe the 61.8. None of this would kill, believe it or not, the longer-term uptrend in the market. If we go down to 100%, and those aren't out of the norm, I could chart this till the cows come home historically and show you lots and lots of these times. So folks, my point this evening is, while nobody's going to like it in terms of their portfolio, what they see here, and we can talk about what might be good from a Trump presidency in terms of corporate tax reform and regulatory reform and that sort of thing. The things relative to our trade agreements, relative to immigration, I can tell you a lot of clients disagree with me, and I'll give you more color as to why I think this way. But I'm with the markets on that. Those are not good policies for our markets, not good policies for our economy, and so forth. They're not even really policies at this point, and I suspect maybe they're more rhetoric. And if the market wakes up and realizes that Trump administration really isn't going to do mass destruction to existing trade agreements and tariff everything from every other country, then I think we might wake up and you might see kind of a Brexit type result. And again, a president by himself or herself, of course, can't do these things independent of the process. So right now it's a shock. Right now it's a surprise. May or may not happen. May ultimately, in the long-term scheme of things, be a good thing or a bad thing, but it's not what the market is made of. The market is made up of business people using resources the world over, putting them to use. The setup for the market, you clients, as we've done the review meetings, I've shown you a lot of data that actually shows a pretty good technical and a decent fundamental setup going forward. If Trump wins, it's going to change the narrative as we speak. Before all this happened this evening, there was an 80% chance, 80+% chance in Fed funds futures of a December rate increase. Suddenly, it's dropped to 50, and it's probably going to continue to drop. And that's just because of the uncertainty. Fed funds futures traders are accurately assessing the Fed and the commentary from the Fed and the things that they worry about, and they realize that the uncertainty at this juncture is something they probably would be uncomfortable with if they were having their meeting today. It's going to seem like a long time between now and then, and a lot can happen. A lot of data is going to come up and so forth. So folks, anyway, I think I can quit rambling there and just basically tell you that regardless of what happens in the morning, we got to go a long ways down before we even talk about breaching a level that would just be a normal retracement. We probably do, and I'm sure we do, break the 200-day moving average. We did that here with Brexit. We're about to do that again tomorrow morning if this holds. And then we got to watch that closely because that tends to be a pretty good line of support. It actually broke in fact, let me show it to you. It broke the 200-day moving average, but it just couldn't really maintain that break, as you can see right here. So, in fact, let me get rid of the green line. So this is actually just the Dow. And you can see that Brexit shock did it. But the slope of the 200-day remained in the right direction, and we really just had a 2-day break. It's a very positive slope right now. That would take us down below that, and then we'd see if that became resistance later. So I'm giving you the technicals because that actually helps us put into proper perspective, historic perspective, really how markets tend to react to shocks like the one we maybe are about to get. So, folks, thank you as always for watching and listening. Obviously, I'm going to have a lot more commentary in the days to come. Take care. Bye.